All right, so hello everybody. Welcome to the best tax webinar ever featuring Rob Mackey. My name is Eric Danielson. I'm the Communication and Client Services Administrator at AFP. So we are recording this webinar and we will be recording future webinars as well. We will hold a Q&A session after the webinar and we will stop recording this before the Q&A session. So this video will end up being posted on our website within the next few days here. And in order to make sure this runs smoothly, we have muted all your mics until the end of the presentation and also disabled videos as well. So if you have any questions, feel free to type them into the chat. So in order to do that, you just click the chat bubble icon there, which will open the window and you can just type in your questions. And depending on what they are, I'll try to answer them during the presentation if I can, but otherwise we'll address it at the end. So if you have any suggestions for future webinars, we encourage you to post them in the chat as well, or you could always just shoot us an email or give us a call afterwards. But with that being said, I will hand things off to Terry, Rob, and Nathan.
Thanks, Eric. Appreciate it. And on behalf of Alexander Financial Planning, we're glad that you have taken a little time out of your day today to be a part of our webinar. We are looking at year 2 here. We started these last year and we're kind of moving into our second year of doing some of the webinars and exploring some topics going forward. But because of the changes in the tax laws last year, they just seem pretty significant or could be very impactful for a lot of people. So we thought, what better thing to start out with a new year than taxes? Rob is a CPA in the Grandview area, very close to us. And we thought, what better person to help us present this information than to ask Rob to be here. So we are hosting him today for this webinar. And in regards to what we are seeing here, this is a lot to unpack, but we're going to try and hit the highlights today and just kind of see where we're at. But it's a lot of this information is very new, right, Rob?
Yeah,
we're seeing. Yeah, still
working. Thank you for having me. I appreciate the opportunity. Happy to be here this morning. Just to give a quick introduction for those of you who haven't met me yet, my name is Rob Mackey. I have a CPA practice here in Grandview. Been a CPA since 2004. I've had my practice here on my own for the past 4 years, coming up on 5. And really am looking forward to this conversation. I think there's a lot in these 2 acts that we can talk about and hopefully save somebody $1 or 2.
Yeah. All right. So we'll get into it, Eric. So this first act that we had take place, that was in August, right? That they put this into play. And I know that there was a whole lot in there, but we're kind of hitting 2 key areas of this act that would pertain to individuals at this stage of the game. So Rob, maybe you can kind of go through and we can talk about the clean energy tax credits.
Yeah, the Inflation Reduction Act really doesn't add a lot law-wise. And you'll hear me say this a couple of times, I think, is that these credits, like the clean energy credit, really renames, extends, and expands already existing credits. So when we're thinking about the new clean energy credits for the vehicles, we've had these credits in place. They were set to expire at the end of 22. So these laws just expand and extend. So the new clean energy credit under Section 30D is for purchases after 12/31/22. And like the slide says, we're looking at a tax credit of up to $7,500. There are a lot of limitations as to the vehicle, the household income, battery components, gross weight of the vehicle. What I like about this law is that it's changed who's responsible for the reporting, right? It used to be that you bought a car and you went to the IRS's website and saw, has the manufacturer had 200,000 vehicles already this year sold or not? Now, you don't really have to worry about whether or not the car is a vehicle under the Clean Air Act, because the dealer is going to give you a report, and the same report to the IRS, that tells you the allowable maximum credit. So you should know when you're on the lot whether or not this vehicle is qualifying vehicle, how much the potential credit is, because this credit, unlike the previous, is kind of split between two components, one for critical mineral requirements and the other half for battery components. But the nice part in my mind is that you don't really have to know anything about it.
Yeah.
You can know whether or not the vehicle qualifies as soon as you see it. As a matter of fact, I'm going to paste in the chat right now a link to the Department of Energy that you can look up the VIN. So if you're on the lot and you see a plug-in electric that you think is attractive for you as a car, and you're thinking you might get a credit on it, you can plop the VIN right into this website and it will tell you whether or not that vehicle qualifies. So
Oh, that is awesome, Rob. That's wonderful. And I didn't realize that the dealership had to have that listing, because otherwise it gets a little fuzzy prior to this.
Right. Yeah. I think it was a little confusing to people that you'd go out and buy a car that was a clean vehicle in your mind, but the manufacturer had already sold 200,000 of them, so it was no longer a qualifying vehicle.
Yeah.
Now you're going to know when you're on the lot whether or not this is going to be good for a credit.
Yeah. And Nathan was bringing up a point earlier about maybe getting more clarification on this, right, Nathan, in March?
Yeah. So the IRS is still determining the final criteria, and so from what I've heard is March is kind of the time period where they're looking at finalizing these requirements. Of course, the manufacturers are trying to have their say, because as part of this act, they have said, we want the source material to come from the U.S. We want the final manufacturing to be in the U.S. And so there's been pushback from companies like Hyundai, Kia, saying, well, hold on a minute, we've invested very heavily in the US, so you should make an exception for us to these rules. Otherwise, this is going to cause a great deal of harm to our business. And how we project our business going forward. So there's still some ambiguity there as far as what this will look like later on in 2023.
Yeah.
And I think it's also important to note that these tax credits are non-refundable. So if your total tax bill, I believe is less than the 7,500, you won't be able to take advantage of the full amount.
Yeah, that's a good point.
It's a great point, but I think that we also have a little bit of a workaround in this act. It's absolutely true that we do have AGI limits of 300,000 for married filing joint, 225 for head of household, 150 for singles and married filing separate. And then we have the MSRP limits on the vehicles too. But once you know that the vehicle qualifies by searching on the Department of Energy's website, obviously the AGI limitations still are in effect. So they know what the maximum available credit is for that vehicle. They don't know your particular tax situation.
Yeah, that's true. Okay.
In this law, though, the vehicle, the credit can be sold by the purchaser to the dealer. So for instance, if you're limited by your AGI, it's over $300,000 for a married filing joint couple, you could take that maximum credit that's been determined and sell that to the dealer for a reduction in the purchase price.
Really?
If you
Oh.
are limited on the AGI, you can still maybe take full advantage of the credit by selling it to the dealer.
Wow.
We're waiting for guidance from the dealer side as to whether or not they can get pre-funded for credits and just take them off the purchase price. So we
Okay.
might see some wheeling and dealing with these credits on the dealer lot.
That sounds great. Well, let's move on to the next slide because we have a lot to cover. Okay, the second part of something that I find interesting related to the Inflation Reduction Act is the home improvement tax credits. So, Rob.
Yeah. So again, the act renames, extends, expands the tax credits. A lot of these are going to be familiar. It's actually two separate credits. We're looking at one for home improvements and then one for clean energy. So when we think about the home improvements, we're talking about windows, doors, heat pumps, water heaters, those, all that energy efficient home improvements. We have an annual limit now of $1,200. It's a 30% credit, used to be 10. It eliminates the lifetime limitation and puts an annual limit of $1,200 now on these. So residential energy property, windows, doors, heat pumps, and energy audits all qualify, but the combined limit is $1,200 per year.
But it's renewable. I mean, every year you can have that 1,200, whereas before, wasn't it like 500 and you used it up, you were done?
That's right. Now, the only one that doesn't have the annual renewing limit is doors. There's a $500 aggregate limit on doors.
Oh, okay.
Exterior doors, I should say.
Okay, good to know. All right.
Residential energy properties where there's a $600 limit include gas and electric, heat pumps, and heat pump water heaters, central AC, gas, propane, oil furnaces, and water heaters and boilers, and biomass stoves. So if you want to put a like a pellet stove in maybe a den or something that, air your home that doesn't get heated well by the central furnace, you can look at a $600 credit on that.
Okay. Well, that's great. Okay. Anything else you can think of on the Inflation Reduction Act? I mean, those were the two that kind of stood out to us before we go into the Secure 2.0 Act.
Yeah, I mean, so we talked a little bit about the home improvements, but there's also additional credits for solar electric, solar water heater, fuel cell technology, small wind and geothermal on a residential property. I think the other thing that is kind of key in my mind with the Inflation Reduction Act is for these home improvements and clean energy improvements for residences, it used to need to be your primary residence, and that's no longer the case. So now it's a dwelling that you use as a residence. So you might want to make improvements to your cabin in the woods, Nathan. I don't know. Right?
Need to have a cabin in the woods.
So if you have your primary residence, and then you have a weekend escape, these credits are now available to that.
Ah, good to know.
There is, not to circle back too much, but on the energy credits, we now have a new law for used clean vehicles. So not only do we have a $7,500 credit for new clean vehicles, there's also a $4,000 credit for used clean vehicles. A lot of the same restrictions apply, and the only caveat on the used one is that the taxpayer can't be a dependent.
Okay.
So buying a used car, buying a used Tesla for your son or daughter, they can't take the credit.
Okay.
There are a lot of other provisions, but they're mostly for commercial trades and businesses.
Okay. All right. So we'll move on to 2.0 as Secure Act, Eric. Yeah. So this one's packed full of stuff. I think what 90 changes, I think is what I've heard, maybe more than that. But so we're going to hit the highlights, things that might be more impactful, I'd say.
Yeah.
Okay. So RMDs.
RMDs, the ages are changing. And I think this slide does a great job of summarizing it. The way the wording is in the act is a little confusing, just because we have these periods where it's 72, it's 73, it's 75. But I think this does a great job of summarizing that, you know, if you're attaining the age of 72 after last year, and you're age 73 before January 1st of 2030, the age is 73. And it's 74 if you're 73 after 2029, but 74 before 2033, and then 75 for essentially anyone who turns 74 after 2032.
So basically anyone turning 72 this year, they're getting a pass in the sense that they don't have to take their RMD this year. But if you turn 72 last year, you still have to continue taking your RMDs. It does not impact you specifically. And if you haven't taken your RMD yet and you turned 72 last year, you still have until April 1st to take your RMD, but you do have to take it in that respect. You know, the thing that comes to mind here, I think more than anything, is that people are getting this idea that, oh, I can delay taking my RMD. I mean, anybody born after 1960, they're not technically going to have to take theirs until after 75. But the point here is that when we run long-term projections, we see that if people are taking RMDs and waiting until you know, their required minimum distribution date, they may end up taking out more than what they need, and that can push them into a higher tax bracket, not only from taxes, but also for Medicare premiums. So it is something that we really have to be mindful to say, maybe even though an RMD is starting now in 73, we might have to start taking money out of our retirement accounts prior to that, so that we don't get into that situation. The only way to look at that and identify that, I think, is when we run these long-term projections for clients, so they can really determine whether that's going to impact them and to what degree.
Right.
So, yeah. So anyway, that's kind of it on that. And I think we need to kind of, unless we have anything, I think we need to move on to the next, because we will run out of time if we don't keep going. So new catch-up rules for contributions to retirement accounts. And to me, this is just really squirrely that you're only having people age 60 to 63 having access to this. Maybe they'll expand this, but do you have any thoughts on this one, Rob?
Well, so I have a couple thoughts on this. Before we hit this directly, I do want to point out that we do have inflation adjustments throughout this act, including to IRA catch-up contributions for those age 50 and over. Yeah, so beginning in 2025, those age 60 to 63 can make a $10,000 catch-up contribution or more, right? Because we're still indexing everything for inflation again, starting in 2026. So some of these numbers are, like you said, a little squirrely, and that it's limited to these age groups is interesting.
Yeah.
So reading the text of this act is a challenge. I will say that there's a lot in here that amends previous legislation without directly stating some of the facts that we glean from it. Simple plans are cut in half as far as the catch-up contributions go. It's just these age brackets. We have the inflation adjustment for everything beginning in 2026. It's great if you're someone working age 60 to 63. It's a great opportunity to squirrel away a little bit more.
Yeah, that's true. Very true. Yeah, it's a plus for sure. Yeah.
We do need to point out with this that if in the prior year you earned more than $145,000, any of your catch-up contributions are going to be designated Roth contributions.
Right. That's on the next slide, actually.
Yeah, I think that's on the next
Sorry.
slide.
You're getting ahead of it, Rob.
Next slide, and look at that, Eric. Okay. Is it on this one or the next
Or
one?
the next one.
Yeah, sorry about that.
No,
Okay, we're flipping topics here, then we'll come back to that one. Sorry about that. So there's been a whole lot of changes here, potentially for the 529 plans, and I know the devil will be in the details, and that's not really known at this point. But maybe we can go through each of these bullets and kind of get a sense of what's going on here.
Mm-hmm. Yeah, we are going to wait for guidance from the IRS on almost all of this act. But as we read it now, rollovers from a 529 plan to a Roth IRA are going to be penalty free. They are limited to the normal Roth contribution limits, and the lifetime maximum rollover from a 529 to any one beneficiary's Roth is $35,000. I think we have in here, yes, 15 years. The 529 plan has to have been established for 15 years before these distributions can be rolled over to a Roth IRA. Contributions within the last 5 years can't be transferred. I think that this makes 529 plans much more attractive than they were before. And I think they can be used more in planning, estate planning, because 529 plans are pretty flexible, right? So I open a 529 plan. I can open a 529 plan for anybody, right? I can open one for Nathan's kids.
That'd be awfully nice of you.
Yeah, it'd be awfully generous.
Go for it.
So you can do that. But 529 plans, you can change the beneficiary, right? So if I have a 529 plan that I opened 20 years ago, and I've changed the beneficiary, I can change the beneficiary again. I can distribute from it to that beneficiary's Roth IRA, assuming that they have earned income, up to the Roth contribution limits, $6,000 or $6,500, whatever it is for this year. Then I can change the beneficiary and do the same thing.
Rob, do you have to have earned income
To contribute to a Roth?
Transfer?
I mean, this is subject to the Roth contribution limits.
Yeah, and you have to have earned income for that. Yeah, that's interesting.
You have to have earned income for it. Yeah.
You might have a lot of older people going back to work. Yeah.
Well, so I think the beneficiary would have to have the earned income.
Yeah. Okay. Interesting. All right.
So
Yeah. There's just this is all new. This is a very new component, and there's just a lot of what ifing going around this one right now.
Yeah.
Yeah. Yeah. So anyway, a new, stay tuned. Need more detail on this one to really put it into motion, but it is in effect for this year, is it not?
No, don't do it this year.
Next year?
Wait till 2024.
24. Okay, got it. Yep. So they have some time to give us some more guidance.
That's right.
Next slide. Changes to the Roth. So here's a little bit of that.
Yeah.
That you were talking about before.
Yeah. So I guess I touched on the catch-up contributions for those making $145,000 or more in the preceding year, those contributions, the catch-up contributions are going to go to the Roth portion of a defined contribution plan. I think it's great that they've eliminated the RMDs, so it's more similar to a Roth IRA now, and that just makes a lot of sense. I think I would almost put this under like the technical corrections kind of section.
That's true.
Yeah.
And you know, there aren't a lot of plans that offer the Roth component for 401k plans. I mean, it has to be a part of their summary plan description, and there aren't a whole lot of plans that are offering that. But for the ones that are, probably haven't had too many people that have taken the Roth contribution part of it. But I mean, it was different than a regular Roth IRA as far as you don't have to take RMDs for that. You know, not to get technical here, but if you have a beneficiary Roth IRA, you do have to take the distributions out of it. Maybe not be taxed, but you had to take the distributions.
Right.
Yeah. So it gets really tricky. Okay, let's move on to the next slide. It's always trying to remember what we're going to talk about next.
Yeah, and here we're touching on the emergency fund provisions, and this is we're still talking about employer defined contribution plans, and this is creating kind of a sub account within the plan that is an emergency savings account. You know, a lot of the provisions here, contributions can be made up to $2,500, for instance, with this provision. But again, it's going to go back to the employer's plan. The employer could set a lower limit on the emergency savings portion of the plan. It is a designated Roth account, and the withdrawals can be made up to 4 times a year, and I believe repaid within 3 years. So there's some, they're trying to encourage individuals to have an emergency fund, right? And if your employer says we're going to put into this for you, we're going to auto enroll you, we're going to match some contributions into it. That's, I think, fantastic.
Mm-hmm.
For most people, it's kind of a not really a thing. It's $2,500, I think, is not huge. It's great that you can kind of build on that year after year. It's nice that you're able to make those emergency withdrawals up to 4 times a year. I think from a broader view, retirement savings planning perspective, it doesn't do a lot for me.
Yeah.
Right. I can contribute post-tax dollars to a savings account and withdraw and put money back into it as often as I want to. Here we might get some employer matches, which would be nice.
Mm-hmm. Yeah, and I think they say the average emergency is like 2,300 or something of that nature, and I think maybe that's why they put the 2,500 amount in there. But yes, it is a contribution that is coming after tax. It's not a pre-tax contribution, other than right. you could have that employer match on that, but it's people. You know, they've tried to recognize most people don't have emergency funds, and it's a way to instill that potentially into people's pictures so that they're not dealing with a crisis situation.
Yeah. And by automating it, potentially, then that will make it more likely that those folks that do not have any emergency savings will have some sort of buffer there.
Yeah,
so,
makes sense. Yeah. Okay. Next slide, Eric. A lot of this is stemming around retirement plans or qualified 401ks, 403bs, that kind of thing. So anyway, this is getting back to IRAs, predominantly, though. And you know, the one thing is that there are, we've learned, like deferred comp, Ohio deferred comp does not allow people to take a qualified charitable distribution. So there are some plans out there that don't allow you to do that. With an IRA, you can.
Yeah. And you know, the slide says no changes to qualified charitable distributions, which I think by and large is true. But they are going to be indexed for inflation.
Now, yeah, that's
Yeah.
true.
And I think that they also increase the amount that you can do annually. I think it's 100,000, I want to say.
It has been 100,000, I thought.
Or is that's what's indexed to inflation?
Yes, that's
Yeah,
what's
they're
indexed.
indexing that.
Yeah. And then they haven't eliminated the backdoor Roth contributions, which is something that they have been threatening, and thank goodness they did not do that one.
If
So,
anything, they expanded the Roth contributions. I mean, not
Yeah.
for the individual, but for beneficiaries with a 529 plan.
absolutely, yes. So they're not taking away the Roth, they're actually expanding it. So, yep, okay. Anything else, or ready for the next one?
Yeah, so let's see what's on the next slide.
That's it.
That's it. Okay, that's what
Is
I thought.
that
Yeah.
All right.
So since that is it, I will say that there are a ton more things in the Secure Act 2.0. You know, we talked about RMD ages, catch-up contributions, 529 plans, Roth. There's an age increase for ABLE accounts. The age limit used to be 26. That's bumped out 20 more years to age 46 for blind and disabled people to save. There's auto enrollment for defined contribution plans has expanded. There are a handful of provisions for small employers that are starting new defined contribution plans. There are some generous credits for small employers that are just starting off with a 401k plan, for instance.
Yeah, and Rob, I think for instance, if you have like a solo 401k plan, it used to be you had to have the plan established before the end of the year. And I think that has been waived and changed, that you could start it this year for last year now.
That's right. Yeah. So for sole proprietors or single member LLC owners, you can retroactively create a plan that goes back to the beginning of, in this instance, 2022, and make those employer contributions as if they occurred in 2022 now.
Yeah.
That's right.
Yeah. So it seems like there's a lot in here, and it just kind of depends on one situation as to whether it is going to speak to them and what's happening in their picture, or maybe it will not be impactful for some people, but it may be impactful for their children or somebody else, you know, within their sphere. So that's why it's kind of important to kind of keep your radar screen up on some of these things to see how that might affect people's different situations. Yeah. And the years that these are going into effect, there's different years. So we unfortunately did not address that as well as maybe we should have, but some go into effect this year, but others are going into effect next year and the following year.
That's true. You know, well, so some like the 529 plans start in 24. Some of the inflation adjustments begin in 26. So yeah, they are kind of all over the place as far as
Yeah. Okay. Hey, Rob, thank you so much. I mean, I know we didn't have we didn't want to get too crazy on the time on this one, but I think it's enough maybe to give people a sense of some of the changes that are going on. And I know we're more than happy to answer anybody's questions after this, but we will stop the recording so we can have that portion of our webinar. So, but thank you, Rob, really appreciate it.
Thank you, Terry. It's been a pleasure.
Yeah, thanks, Rob.